Welcome to Yahoo Finance's special coverage of the November CPI report. I'm Julie Hyman, and we are getting the numbers for November now. Year-over-year inflation milder than expected, rising 2.7%. Economists on average have been looking for a 3.1% gain. Core CPI, excluding volatile food and energy prices, up 2.6% year-over-year versus the 3% that economists had been looking for on average. Now, we're not getting the month-over-month numbers, remember, because of the government shutdown. The government was not able to collect the full cohort of data that they normally would. And so that's why we're not getting an October number or a full October number, and therefore not getting a month-over-month reading from October to November. That's why we're just getting the year-over-year number that we just told you about. Again, much like the jobs report a couple of days ago, this one is a little tougher to parse through. Even though we have that November number, there are questions about how solid that number is because of the shutdown, because of the interruption, and will that have then knock-on effects about how they collected data during the survey. Now, all of that said, this number is presumably good news in terms of both from an economic perspective for consumers that are hungering for prices to not rise as much or even to come down, but that is obviously not happening as reflected in this report, but also potentially gives more room to the Fed to cut if you've got unemployment rate of 4.6% and year-over-year inflation that is decelerating. That's a good recipe for another potential Fed cut. We are seeing futures extend their gains at the sort of first blush reaction to this. All three major averages indicating gains at the open. We could see some volatility following this. NASDAQ futures in particular, which have been weak as of late. NASDAQ 100 futures now pointing to a gain of more than 1% at the open. I'm going to keep going through this release to see kind of what the components look like. But again, the top line numbers look positive. So let's talk more about this report now. Joining me to break it down is Steve Sosnick, Interactive Brokers Chief Strategist, Claudia Sahm, New Century Advisors Chief Economist, and also former Federal Reserve Board economist, and Leslie Rosner, Goldman Sachs Asset Management Head of Multi-Sector Fixed Income Investing. Claudia, I saw you were literally head down looking at the at the numbers there, because there is obviously a lot to go through here, and it's a more complicated release even to read than normal because of these interruptions. But I am curious just kind of what your first blush reaction is here.
Right. Well, I mean, we always want to see inflation numbers that are down. So, downside surprises are better than upside surprises. But as you mentioned, I think it is extremely important to take this release with a big grain of salt. The data collection, the way the Bureau of Labor Statistics constructs the CPI, it was really disrupted by having a month off in October. And so I think we're just going to have to see more data next Monday before we really start running with this lower number.
And Lindsay, I'm curious what you think as well, because I know that I think it's fair to say almost everyone who's watching for this number is taking it with that grain of salt. So what do we do with this data then?
Yeah, I think it may even be more than a grain. I think it may be an entire bag. The reason there being that there are a lot of caveats. We even heard from the BLS yesterday, take these numbers with this potential bag of salt because of all the issues that Claudia mentioned. One thing I'd point out in particular that I think will really resonate with the listeners is that the sampling for November specifically was focused around the timing of Black Friday. We all know how good the sales were. And so when you look at those numbers, yes, it's going to look like prices were lower. So this soft optic number of inflation seemingly lower, while we really would like to get excited about it, I don't think it's deserving of excitement. So on the going forward, it really is about getting more data and understanding it. I think, though, this does support our general view that inflation is trending in the right direction, and that the labor market is what we should really look at. And that's what's going to drive predominantly the Fed's action going forward.
Yeah, in the right direction, even if not quite dramatically as is reflected in the numbers today. Steve, let's take it to you. As I mentioned, futures, the stock market, shall we say, is not known for its reading of nuance, right? So the stock market doesn't care that these numbers maybe aren't, that exactly accurate. they're buying first and asking questions later.
That's the typical modus operandi of the stock market. On the surface, there's no question that the numbers look good, and I take the caveats that the others brought up. But as you're right. Stock traders shoot first, ask questions later. You saw it. We had our usual sort of 2 to 3 in the morning rally in the futures.
I know you've been watching that pattern lately.
It's pretty much consistent that's what's going on. At least today you had the Micron story to give it actually a real reason to do that. But why not? It's a very thin market around a number because just the mechanics of market making, you shrink your sizes, you widen your quotes until everything sort of settles down. And I think that will, we should settle in for the morning at a higher level, but it's certainly, I'm not going to go crazy on this one. There's a lot of other factors.
Yeah, most definitely. That's okay. So that seems to be the consensus here. Lindsay, I'm going to go back to you then on the other piece of what you said everybody is now watching closely. And the Fed is clearly watching closely, and that's the unemployment rate and the jobs picture, right? So I guess what I would ask is, put the unemployment rate that we got on Tuesday together with this maybe iffy number today. Does the Fed have enough to cut in January?
Yeah, so the unemployment rate at 4.6, I think it's important to think a little bit more deeply about that one as well. So if you unround the prior unemployment rate and you unround the 4.6, the difference between the two is not the 20 basis point headline of 4.4 to 4.6. It's actually just 12. So it's moved up. It's not maybe moved up as much as the headline suggests. However, the labor market does seem to be moving in a softening fashion, but the data that we got there too was also impacted by kind of idiosyncratic events. For example, the big 105,000 down number mostly was DOGE resignations that were deferred. So the labor market is where we are focused. We do think it's softening. We need to see how much softer it's getting. Our call is that the Fed's going to cut twice next year. And what happens with the labor market? If it continues to move in this direction, I think that's confirmatory. If it's worse, then we could expect even more cuts.
Claudia, what do you think of what we're hearing from Lindsay here?
Right. Yeah, I agree. And, we should remember we're missing the October CPI. We're also missing the October unemployment rate. There were disruptions in those data as well. And key for those of us thinking about how the Fed interprets it, before the Fed makes any decisions, they're going to have another read on both the unemployment rate and the CPI. And so I think that's where they're going to be able to take, next month will be really important to kind of, as we work through these disruptions, the data fog is lifting gradually, right? Just because we have numbers doesn't mean that they're just, it's of the same, quality that we had before all these disruptions started.
And Steve, again, to bring it back to the market, I had an interesting discussion yesterday with Kantrowitz from Piper Sandler, and he said that the unemployment rate rising has actually historically been good for stocks because of the implication that it will result in falling rates. So is that how people should be thinking about what's going on here?
It's a little mental jujitsu. I mean, The way I'm referred to it is we almost need like a reverse Goldilocks, not cool but not cold. Not too cold, but not too, not lukewarm either. If you're in the camp that rate cuts are all that matters, and to a certain extent, that's the mindset of the stock market. I was looking at I had the Fed funds, futures up on my screen. They're getting closer to predicting an April cut as opposed to June, which it was before. It's about 95% now.
So they're bringing it forward.
They are bringing it forward, especially when you have, basically the Fed governor, the Fed chairman competition with, apprentice Fed edition, which is basically doviest. And so it's really a question of who's catering to that and to what degree. So the stock market is fixated on this. My concern, of course, is if things start to unwind in a worse way than predicted, the Fed might be behind the eight ball, especially, as Claudia just said, there's a bit of a data fog that needs to be fully cleared.
I do want to linger for a moment on the Apprentice Federal Reserve Chair edition, because the odds keep changing, right?
Yep.
First, you had Kevin Hassett seen as the clear leader in the race. and it's amazing that we're talking about a race for Fed chair, but then Warsh gained, and then after the president reportedly interviewed Christopher Waller, if you look at the odds makers, is now sort of rising in the odds, if you will. Claudia, as somebody who was worked at the Fed and someone who thinks a lot about the Federal Reserve, how are you thinking about this leadership situation and what each of these individuals could mean for the future of Fed policy?
Yeah, it's, the Fed is it's gonna change next year. The chair, while they are one vote on the committee, they are a leadership position, and it does change, if nothing else, the style and kind of the direction of the Fed. So it's an important choice. I think what really hangs over this whole process is these concerns that we're not getting a new Fed chair, we're getting the president, the White House with more influence at the Fed. And that's not my base case. I think all three candidates are qualified. I think they'll, move into an institution. They have all the skills to be independent of the White House. But we're going to spend most of next year guessing, is this driven by the data? Is this driven by the White House? And that's a really unfortunate setup for a year where the economy could still be, really confusing and potentially things sliding, downward. So it's an unfortunate setup. And it's really the way the process has been run. And we shouldn't have a president promising more of a Fed chair that'll pull rates down. That depends on the economy.
And I'm also curious, Lindsay, from your perspective, what all this is going to mean for the rates market, right? Because already there's been a lot of debate about what that Fed chair is going to mean. Not only that, we have a lot of Treasury supply and corporate bond supply coming into the market next year. So there's been a lot of discussion about that. So what are you going to be watching to try to figure out your strategy given all of these cross currents?
Sure. So we still believe that the Fed will be independent. So we go from the same playbook that we've always gone from, which is look at the data and see how this evolves. The things that we're looking to see play out, I think, are big picture economic themes. Is AI, there's been a ton of CapEx, and back to your point, issuance around the AI theme. Are we starting to see that translate in productivity? There has been a boost to GDP this past, the 2025 from AI, but a lot of it has been in the form of CapEx. It'll be really interesting to see if 2026 AI comes through translated into productivity. So we'll be looking at the data, we'll be looking at AI, and we're looking to see back to the labor market, just how it hangs in. So far, we've had this jobless recovery, and we think a lot of it has to do with this technological advance in AI that at this point in time does not need jobs. Does it include jobs on it going forward? And if it doesn't, does that then incentivize the Fed to cut?
Right. Well, Lindsay, my enduring image from today will be a giant bag of salt, especially after the snow in the New York area. It's on my mind. Thank you so much.
Sprinkle it.
Yes, exactly. Steve and Claudia, you're going to stick around. Lindsay, thanks very much. And we got to check on what's going on in the markets in a little more detail. Jared Blickery is here for that.
Thank you, Julie. Let's take a look at the indices. We saw a definite bullish reaction. I'm going to start with the Dow here, and this is since midnight, and you can see we saw a spurt up there. Although we were already in the green, Dow futures now up about 250 points, or 0.5%. S&P 500 up a bit more, 0.8%. There's that spike off the report. NASDAQ even more than that, 1.4%. Smaller spike, but it was also up more before the report. And the Russell 2000 really just the most outsized reaction. You can see that big spike there, 1.34%. So stocks loving this move right now. And let's take a look at the futures. Now, these are 2-year U.S. Treasury note futures, and these are going to be going opposite interest rates. So you can see it's been green all night. That means interest rates have been going down. And off the report, we actually saw a bit of a spike up. That's been reversed. We're only seeing a little bit of movement there, but the net reaction is we're seeing yields ticking down just a little bit. That's a 2-year. Let's check out the 10-year as well. Very similar, but we're seeing more of a reaction here to the upside, meaning yields are coming down more. And let's take a look at some of the other markets. And gold futures is something I like to look at. Why would we have gold futures spiking here, even though we're getting less inflation? Maybe because of the rate situation. Rates tick down, that enhances the favorability of the gold trade. We don't usually see a reaction off of crude oil futures. They were already up, and indeed not much of a reaction there. Here's Bitcoin, though, and we saw a spike up in Bitcoin. This is a reaction that I haven't seen in crypto in some time, even going back a couple days to the non-farm payrolls report that we saw. Bitcoin has just been kind of doing its own thing, but it is going in the risk-on direction here, so that might be notable. Now let's check out the sector action, and this is going to be what happened yesterday. Tech down 2%. I think that was the second time this week that it was leading down. Industrials also underperforming, energy in the top spot, but things have reversed this morning, and you can see in the upper left now, the little rectangle is the pre-market quote. That's 1.71% for XLK, that's tech. Then we have XLY, that's consumer discretionary and communication services. Those are the mega cap sectors. So might be another rate situation where we see rates ticking down and some capital automatically flowing into some of those names. I'm going to show you the NASDAQ 100. It was an ugly red day yesterday. That's all that red in the background you see, but the little rectangles, they're flashing green. We got Nvidia up 2% in the pre-market, Alphabet just a little bit behind, Tesla up 2.4%, Broadcom up 2%. And if we take a look inside the semiconductor industry, which just got obliterated yesterday, seeing a lot of green there this morning too. Micron, by the way, up about 14% in the pre-market. So that's going to be one to track today. So probably on the bet, we were already seeing this pre-market, pre-report, because the Micron earnings were kind of juicing the tech sector. Not so much the software sector, but we're seeing a lot of green here too. So should be a decent day for tech unless we see one of those rare reversals. And I will say that we don't see as many reversals off of CPI data as we do the non-farm payrolls, although it has happened.
Right. That is a great point and perspective, Jared. Thank you. Coming up, we'll have more on the November CPI report and what inflation implies about affordability right now. We'll be right back.
Here at home, we're bringing our economy back from the brink of ruin. The last administration and their allies in Congress looted our Treasury for trillions of dollars, driving up prices and everything at levels never seen before. I am bringing those high prices down and bringing them down very fast.
That was President Trump addressing the nation about the rising cost of living. The president announced a military holiday bonus and said new housing reforms would come next year. So with me, Claudia Sahm, New Century Advisors chief economist, and Steve Sosnick, Interactive Brokers chief strategist. And guys, the president is now acknowledging there's an affordability problem, although he's sort of gone back and forth about that and addressed it in those comments last night. But he is finding that by some metrics, the economy is okay, but people clearly don't feel okay. Claudia, you've written a lot about affordability, and I think one of the interesting things that you pinpoint is when we talk about affordability, we really concentrate a lot on the prices that have risen so much. We concentrate less on the income side of the equation. But as you rightly point out, obviously that's important. Part of the problem is that people aren't earning much more.
Mm-hmm. Right. This was something that Fed Chair Jay Powell was pressed on last week at the press conference. You know, the Fed lowered interest rates and did it because they're concerned about the labor market. And a journalist really pushed him on, but hey, people are most concerned about inflation. Why are you cutting rates? And, you know, he reminded us all, and I think this has been in the conversation, that, you know, really it's important that wages keep growing. They need to grow faster than inflation. And we need to have that happen for some years, right? Like it's going to take time to really make people feel better off. And it is clear from various household surveys, some very long running surveys like the one run out of the University of Michigan, people are not feeling it in terms of being financially more secure. Like we are at really low levels. And so trying to figure out what's behind that, and then what are the policies, you know, that can help get us to a place where people are on a firmer financial footing. That's a really big question. It's tough. It really is.
It is tough. And for people who are watching, when the president says he's going to bring down prices, have prices ever fallen in history without a recession happening?
It's the whole discussion around inflation and prices, like individual prices, like gas prices are something that we see go up and down, right? Like there are times where gas prices fall. For a lot of goods and services, particularly services, we don't tend to see big price declines outside of recessions. Think about what's behind a lot of those prices. It's the wages of workers, right? That are, we just, in recessions, we'll see inflation slow. Sometimes there's deflation, but in modern US economy, it's pretty rare, and it's usually at a really bad time. Like that's not a time where people are feeling better about their finances because other things are happening, like they're losing their jobs, they're not getting, wage increases and all of that. So, it's one of those be careful what you wish for, but individual prices, there are some cases where they're disrupted enough by supply or issue. We've heard about eggs and viruses and gas prices. So I think they can they can pull out individual price series and show this high to low prices. But when we roll that up to like inflation or prices overall, that's where we really don't want to see those coming down, because it will in all likely be very painful.
Of course, we do want to see people earning more. That would be nice, right? And Steve, through the stock market prism, when we talk about the K-shaped economy and the people who are doing better, many of them are doing better because they're in the stock market, and the stock market's been doing better, even if they're not earning more in their day-to-day jobs. What happens if what are the chances the stock market stops performing as it has, and then what effect does that have on all of this?
If the economy really starts to bite people and the affordability crisis bites people, and part of the question becomes, people conflate inflation with the actual price level. Inflation is the change in prices, which rarely goes down, as Claudia noted. And by the way, if inflation is bad, deflation is worse. And so we don't really want that. That would be in many ways catastrophic for investments because of all the debt that's in society. But what happens here is if it gets bad enough, we've democratized investing to a huge extent. People, let's say, who have the money to invest are doing so. Young people all the time, who don't have a ton of extra disposable income are investing in some way, shape, or form. If things get unaffordable for them, they have to get the money somewhere, and particularly if their wages are not increasing fast enough. That money is going to come out of their savings, which are in many cases are investments, and that would be a headwind if we started to see that in a major way. And that is a critical issue here. And as many people like to bring up, there's the big beautiful bill being installed. Let me remind everybody that in 2017 we had the Trump tax cuts and the market cheered those, and 2018 was actually a crappy year for the stock market. It was actually a bear market. And so you do have these hangovers, and I don't recall price pressures in large segments like healthcare and electricity to the degree they are, and that's where people go. If you chart, Claudia mentioned gasoline prices. If you chart the Michigan one-year inflationary expectations versus the price at the pump of gasoline, they track really well. They actually separated this year where the expectations went up and the price of the pump didn't. It's starting to converge back a little bit, but I think that's a big tell in how people are viewing affordability.
That's really interesting that gasoline prices maybe aren't that proxy that they once were because of the other prices. Claudia, I did want to ask you about the One Beautiful Bill stimulus as well, and how, just very quickly, how helpful you think that's going to be for the economy.
So I think it will be supportive, and frankly, we could use some support right now. The cooling in the labor market, while it has been gradual, that rise in the unemployment rate, that is a red flag. And the Fed, taking out some insurance by cutting 75 basis points this year, I think that's a good step. But having some extra cushioning on the fiscal side, both with households getting the larger refunds, but also the tax breaks for businesses and investment, like it could be really well timed to have some extra support under the economy early in the year. And that doesn't necessarily mean that things really just pick up and we have robust growth, but it could help, soften the blow and get we really need the labor market to stabilize and start moving in the right direction.
Yeah, fingers crossed. Claudia, Steve, thank you very much. Appreciate it. Stay tuned for Morning Brief. We'll have more coverage on the CPI report and Micron. Don't forget about that one. We'll be right back. Welcome to Morning Brief, presented by Robinhood, the home to commission-free trading. I'm Julie Hyman, and here's what we're watching today. First up, the November CPI report will dig into the latest inflation numbers and what it means for the Fed's path forward. Plus, we'll discuss the affordability crisis as President Trump looks to address the rising cost of living. And Micron shares are soaring as its revenue outlook really exceeds estimates and then some. We're going to break down the results and what they say about the AI trade. Let's get checking on stock futures here this morning following that CPI report for November, rising much less than had been estimated on a year-over-year basis, with the caveat that these numbers are still a little murky because of the government shutdown. It looks like stocks are reacting positively, viewing this as giving more room to the Fed to continue to cut rates. Right now, we're seeing NASDAQ futures up 1.3%. Guess what? Not hurt by Micron either. S&P futures indicating a gain of about 0.8%, and Dow futures showing a gain of about 0.4%. So let's dig into our top stories of the day. Joining me now, tech editor Dan Howley, Federal Reserve correspondent Jennifer Schonberger, and senior reporter Brooke DePalma. Jennifer, let's start with you. And this, again, the second big data release in a week, delayed data release, and the second confusing one in a week.
Yes, the second confusing one, Julie. I think that caps it off well. The CPI report coming in much better than expected, 2.7 on the headline versus expectations of 3.1, and 2.6 on core versus expectations of 3%. And for so long, inflation has really been stuck around 3% and has been a worry for many of the hawks on the Fed. Today, we see it dropping to 2.6%, which is just 0.1 percentage point above where officials see inflation ending 2026. However, as you say, we had a government shutdown for a month and a half. So there are a lot of gaps here. Take this data as you will. And Fed Chair Jay Powell warned coming into this week that they're going to take a skeptical eye to this data. So I think this doesn't change that much for the Fed at this point. They're going to need to see another probably couple reports of inflation to confirm if there is indeed a downward trend here. And if we dig into this number a bit, core goods was up 1.4%. So we are seeing some upward pressure from tariffs. What really seemed to push this number down was the shelter component. And Fed Governor Stephen Miron has been saying since he became a Fed governor, he believes that as we see rents come down, given the lag in which they are incorporated into the CPI calculation, that will bring overall inflation down. So perhaps today, Stephen Miron feeling a bit vindicated. We'll see if this trend continues. But I also want to point to services inflation because that still looks sticky. It was about 3% if you look at services minus energy, and that compared with 3.5% back in September. So looking better, but I think the hawks on the committee are going to take an eye to that part of this report. Again, bottom line here, Julie, things looking better, but take this with a grain of salt.
Yeah, I'm seeing a lot of chatter online about some of those rent assumptions in this report and really questioning the validity of them. So to your point, that's really going to, I think, get the most scrutiny going forward. One more thing I want to that I know you flagged was initial jobless claims, right? Yeah. With the Fed also really zeroed in on the labor market. Those came in pretty much in line with estimates, but not raising any alarm bells.
Exactly. I think for everyone who was worried, given the last jobs report, that things were really weakening, and given all of the gaps in the data because of the government shutdown and the skewing of that data, this provides a better picture of the job market. And the fact that we're sitting at 224,000 jobless claims versus 236,000 from the week prior, that indicates a pretty healthy labor market imbalance. So for those quote unquote hawks, if you will, on the FOMC who think, yeah, look, the jobs data looks okay, the jobs market is in balance, we're not in an emergent situation here, they're probably going to be pointing to that number.
All right, so that's what's going on with the Fed. We got to talk about Micron this morning because I think I saw one quote this morning, Dan Howley, that these numbers were even more of a shock than NVIDIA's shock when they first started reporting what was going on as a result of generative AI. I mean, these numbers for a memory chip maker that tends to be sort of commoditized product are indeed very surprising.
Yeah, Julie, they beat on the top and bottom line easily. They came in with EPS of $4.78. The expectation was for $3.95. They also beat on revenue, 13.64 billion. The estimate was for 12.95. But really, the standout here was the outlook. The outlook was absolutely bonkers. The original estimate was for 14.3 billion. They estimate that they're going to have in the next quarter 18.3 to 19.1 billion. I mean, that's just absolutely insane to see those kinds of numbers coming through. Okay, so what's the deal here? Why is this happening? Well, it's a huge demand for memory from data centers. And so, this is a part of the AI trade. The stock is trading right now, well, in pre-market, I can't even tell right now, but it's been up all morning. I think 15% around there. And so, the idea that these kind of memory makers are now starting to explode, that tends to lead to, okay, so now we're going to see more data center build out because you need the high bandwidth memory before you can actually get anything into a data center, before you can build a server rack. There's, the upside and downside here. There's the AI trade's been kind of on the downswing. Now, is it going to go on the upswing? There's this back and forth. The other thing is what this means for the average person. We discussed this, I believe, last week or a few weeks back, where the increased demand from data centers means that, well, memory companies are just going to build for data center companies because they can get better margins. Micron said that they're sold out of high bandwidth memory through calendar year 2026 already. And so what this means for the consumer is you might start to pay more for your smartphone, your laptop. Companies may have to pay more for equipment that they purchase. This memory, not exactly high bandwidth memory, but the type that these companies make, DRAM, is found in anything that's basically a computer. So cars, medical equipment, consumer goods. Your washer and dryer has RAM if it's got a computer in it, which it probably does. Mine is very old, so it does not. But the point being that you're going to have to end up potentially either paying more or seeing companies downgrade some of their devices to allow for the amount of RAM that's available to be used. And so, good for AI companies, bad for regular consumers.
And Dan, and Micron is actually migrating most of its supply to high bandwidth, right? What's the timeline for that, and how much are they still relying on the sort of more regular DRAM versus the high bandwidth memory?
Yeah, they're killing their consumer brand Crucial. That's been a brand for memory for years. I mean, I love computers. I've used Crucial memory in my machines that I build myself. And so it's interesting to see that by February they should be exited that market entirely. And so, it just shows that companies are going all in on AI data centers. And I think if you're an AI kind of believer, it shows that, look, this is going to be huge. It's going to continue to be huge. If you're not and you're a little more skeptical, you think, well, why did Micron just exit a market that they could make money off of? So, it's kind of A-B. We're going to continue to see this back and forth. One model's better than the other. OpenAI is beating Google. Google's beating OpenAI. NVIDIA's incredible. NVIDIA's on the downswing. I still don't think anybody understands where the AI market's really going at this point. And so these kinds of ups and downs just feel like they're going to be par for the course now.
Yeah, it does feel a little bit that way. Well, I guess investors are happy it's up today. Let's turn the page and look at a couple of consumer names that I know Brooke is focusing on. First off, we've talked about this name before, Lululemon. Another development in that saga, as the Wall Street Journal is reporting that Elliott, the activist investment management company, is getting into Lulu, which we know is looking for a new CEO, and maybe Elliott has some ideas.
Julia, another twist in this latest Lululemon story. Sources now confirming to Yahoo Finance that Elliott Investment Management has taken a $1 billion stake in Lululemon. And also, they're suggesting who their pick for CEO would be as that search rolls on, with Calvin McDonald set to step down on January 31st, 2026. Two co-CEOs serving as interim CEOs in the search for a new executive coming in. Now, Elliott Investment Management is suggesting that a former Ralph Lauren executive executive. Her name is Jane Nielsen. She's a former CFO and Chief Operating Officer of Ralph Lauren, and they're suggesting that she should be the next pick to take over this athleisure retailer. But keep in mind, Elliott Investment Management has really played a part in multiple different consumer-facing companies, especially in recent past. Just last month, PepsiCo, or earlier this month, PepsiCo striking a deal with Elliott Investment Management, saying that they're now going to cut costs and they're also going to lower prices based upon what they had suggested earlier this year. And also, Elliott Investment Management was one of the companies, or one of the activist investors rather, that had stepped in at a crucial point at Starbucks last August, in August of 2024, and that's when we saw a turnover of CEO Brian Nichols stepping in. And so this activist investment manager definitely has a track record of turning companies to get what they exactly see as the future right path forward. And so the suggestion might be taken, but certainly the search is on for a new Lululemon executive, with Calvin McDonald set to step down next month.
Yeah, I'm looking forward to continuing to track that. And then after the close today, we'll have Nike numbers. And as we know, Nike's had a tough year. A lot of investors are betting on a turnaround to come. What should we be watching for in today's report?
Well, Julie, don't get too excited, because for this second quarter earnings report, same-store sales growth is still expected to decline. But there are a few things that investors are really watching out for. They're really hoping to hear more about product innovation. We know that during this quarter, they teamed up with Nike Skims. They also launched into different lines like football, basketball, training, sportswear. And on top of that, too, really Nike switched over to that direct-to-consumer model. Now they're switching back towards that wholesale model. Also, Bank of America is saying in a note that they're particularly interested about how exactly they played into their Amazon platform this past quarter, with the price point typically under $100. We know that in this environment, consumers are extremely value conscious, really cost savings seekers. And so interesting to see how that exactly played out for them. But all eyes will be on that Q3 revenue guidance. They really want to see that all these investments that the company have made under the new CEO, not so new now, Elliott Hill, did they actually make a difference? And will we eventually see a return to sales growth in that third quarter earnings report? And so all eyes on the outlook.
We'll be watching. Dan, Jennifer, Brooke, thank you so much. Coming up on Morning Brief, we'll bring you today's top trending tickers and count you down to the opening bell. We'll be right back. Welcome back to Morning Brief, presented by Robinhood. Now time for some of today's trending tickers. We're watching Trump Media, BP, and Coinbase. First up, and this is probably my favorite story of the day, Trump Media, the company behind Truth Social, announcing a $6 billion all-stock merger with Tay Technologies. Now, what is Tay Technologies? It's a closely held fusion, that is nuclear fusion developer founded in 1998. And the deal marks a dramatic pivot for the social media company, which is previously diversified into offering financial products. Interest in nuclear fusion has gained momentum since the process was created only in laboratory conditions for the first time in 2022. Indeed, recreating that at a commercial scale would be unprecedented, even though it does offer the prospect of cheap and abundant power with next to no pollution. Most of the publicly traded nuclear companies today are talking about creating smaller scale fission, not fusion. We're going to talk much more about this later in the show, but those shares are up almost 25%. Next up is BP, the energy giant, announcing a new CEO, the company tapping an outsider for the first time ever. It also marks BP's fourth CEO in 6 years. It's Meg O'Neill who will take the helm of the company in April of next year. She's been CEO of Woodside since 2021, and during her tenure, she oversaw the company's acquisition of BHP. Prior to that, she spent more than 2 decades at ExxonMobil. The move comes at a time when BP is facing activist pressure from Elliott Management. O'Neill's appointment is seen by many as a back-to-basics approach for oil and gas. And finally, Coinbase, the crypto company, is pushing into prediction markets and stock trading. Both services will be made available to all eligible users in the U.S. in the coming weeks. It's all part of Coinbase's push to become an everything app, offering traders access to a broad range of assets and markets. Coinbase is also keeping up with competitors who are diversifying their businesses. November's inflation print came in cooler than expected at 2.7%, and because that compares to a year ago, it might cause some to view the report through a lens of skepticism, mainly because the government was shut down. They couldn't collect all the data for October. Our next guest says, ignore it at your own risk. Let's bring in Brian Jacobsen, Annex Wealth Management Chief Economist and Strategist. Brian Jacobsen, we talked to an economist earlier, and other folks who are involved in the market, and they said, indeed, take this one with a huge grain of salt. Is that how we should be viewing this report?
Yeah, I actually think that would be a mistake to take it with too much of a grain of salt. I mean, every data release, you do want to have a grain of salt, probably around the rim of a margarita glass. But I think that when we're looking at this, yes, they did start the data collection a little bit later. We don't have the October numbers. But what I look for, do we have confirming or disconfirming evidence to support this? And some of the biggest drivers of inflation, so if we just look at the consumer basket, shelter costs, right? That's the biggest part of it. That has been trending lower. We know from the Zillow rent indices that inflation is on a downward trend for shelter, for rents. Then we look at the Manheim used car index. We can look at new car prices as well. Those are actually much more important than if we just think about, imports. What's going to happen there? Because imports are about 16 to 20% of goods, but goods, excluding food and energy, is only about 20% of the consumer basket. So when I looked at this, it was a pleasant surprise, but it didn't really strike me as being too much of an outlier or something that we'd want to ignore.
At the same time, Brian, I have seen some commentary already really questioning some of the BLS's assumptions about rent in particular and where they kind of put it for the last couple of months. So, I mean, is it fair to say that this report shows that the rate of inflation is slowing, but perhaps not as much as exactly as the report said?
Yeah, that is a great way to frame it, is that it's moving in the right direction, but maybe not fast enough. It's almost like to draw the distinction between inflation and prices, right? So if prices are still going up, that's inflation. If prices are going down, that's deflation. And it's a question of how rapidly do those processes take place. And it's just, I believe, confirming that inflation is still an issue. It hasn't gone away. It's still a positive number and above the Fed's target, but it at least seems to be moving in the correct direction, even if it's at a glacial pace.
And it also seems to be positive for the equity markets here this morning, right? We are seeing futures extend gains on the back of that number. How are you feeling about 2026, Brian? What do we think that holds?
Yeah, I'm thinking 2026 is going to be a pretty good period for the economy, for the markets, really, that can move according to so many different factors. Starting valuations, of course, are a big concern for a lot of people. Can firms grow into that? That's why we're positioned more towards, small and mid, also looking a little bit more at value, trying to appreciate that the price you pay for the fundamentals really does matter. And it's going to be almost like a show me the money kind of year, where we want to see, is there actually that return on invested capital for all the money that's being thrown at artificial intelligence, data centers, or any type of investment, especially since we're expecting to see a lot of investment spending thanks to the tax incentives in the One Big Beautiful Bill that allows for 100% expensing. So it's not just data centers. It could be buildings, it could be computers, it could be machinery. So really, we believe the year ahead is going to be one characterized by a ton of investment spending, but some of that is like throwing good money after bad, and that's what we want to try to avoid.
And Brian, one of my guests earlier, Steve Sosnick of Interactive Brokers, made an interesting point. He pointed out that when we got a tax bill passed in 2017, once those effects actually hit in 2018, stocks went down. And so I wonder how you think about that, potential risks. Obviously no year is exactly the same as another, but given that history, how do you think about how that could trickle through into the economy and stocks?
It's a great reason to remember about the difference between the economy and the markets, right? We could see the economic numbers being good, but the markets, they could actually look at and say, well, that wasn't as good as expected, right? Because in 2017, I remember that, small caps were going on a tear because they're going to be big beneficiaries of tax cuts. Well, and then all of a sudden, when you actually got the news of it happening, they actually underperformed because the market had already anticipated. Right. So that's what we're looking for, is this differentiated view as far as what's currently priced into the market. And I just think that it's an environment which so many investors have been fixated on AI and its build out that they've been ignoring the other parts as far as where else could there be the investment spending. And then, of course, the old maxim, follow the money. Right? Where's that money going to be spent? And then to really pay attention to what I think is key, corporate governance, the quality of the management, the oversight to make sure that these aren't just vanity projects that they're pursuing, that it's actually something that's going to add value for shareholders.
And Brian, given all of that, but also given the fact we've got Micron flying this morning on its latest numbers, are you rejiggering your strategy with regard to the AI trade specifically as we go into next year?
Yes, that is something that we've been peeling off a little bit. We still do believe in the power of artificial intelligence to improve productivity gains, but it boils back to what price are you paying for that? And that's where we're looking more at, well, whereabouts in, say, healthcare? Where is it that in the service sector that this can be really used? It could be in industrials, it could be in logistics. So it's almost like the next chapter in the story for the AI build out. The first chapter was all about picks and shovels, which was with semiconductors. But then the next chapter is about the use cases and the specific areas in which you can get actually a decent return on investment. And that's where it's leading us to some of those other sectors.
Brian, good to see you. Thanks for joining us.
Thank you.
Coming up on Yahoo Finance is Opening Bid. Our executive editor, Brian Sazzi, is joining us now. He's got the vest on today. I don't know what that signals, but tell me what you got coming up.
It signals, Julie, big news and big analysis on Opening Bid. Every day is a little bit different. And big day for, I would say, Hut 8 yesterday, that crypto miner turned power provider. We're going to have the CEO, Asher Ganoot, on the show to talk about that big deal, which is being backed by Google. But Julie, really quite the morning for AI infrastructure deals, huh?
Quite the morning for AI infrastructure deals and maybe a little nuclear fusion.
Because why not?
You going to put on your white lab coat and try and make it happen?
Yeah. I think fusion, Julie. I still think like nuclear power, end of the world, Chernobyl. But maybe I got to stop making that distinction.
I think it's a valid question, especially if we're going to see some of these projects rushed through, which I think is a valid concern.
Yeah, no one wants blue dogs running around, Julie.
Yeah. All right. That does it for Morning Brief presented by Robinhood. Much more ahead on Yahoo Finance.